Listen, something extraordinary is happening in the gold market right now, and if you're not paying attention, you're going to miss one of the most significant wealth-building opportunities of this decade. I'm not talking about some minor price fluctuation or a temporary rally. I'm talking about a fundamental shift in the global financial system that's about to send gold prices into territory most investors think is impossible. Let me show you exactly what I'm seeing, because the evidence is overwhelming, and frankly, it's keeping me up at night thinking about how many people are going to be caught completely off guard. Right now, as I'm recording this, gold is trading around $2,650 per ounce. That might sound high to some of you. You might be thinking, didn't gold just hit all-time highs? Isn't it too late to get in? And that's exactly what the mainstream financial media wants you to think. They want you sitting on the sidelines while the smart money, the institutional players, the central banks, they're accumulating gold at a pace we haven't seen in over 50 years. Here's what nobody's talking about. In the third quarter of 2024, central banks purchased 337 tons of gold. Let that sink in for a moment. 337 tons in just 3 months. That's the highest quarterly purchase since the third quarter of 2022, and we're on track for the second highest annual total in history. The People's Bank of China alone has been adding to its reserves for 18 consecutive months. 18 months of relentless buying. Why would central banks, the institutions that literally control the money supply, be hoarding gold at record levels? Because they know something, they see what's coming. And what's coming is a complete restructuring of the global monetary system. Think about this for a second. When was the last time you saw central banks agree on anything? They're constantly at odds, competing for economic advantage, manipulating currencies against each other. But on gold, they're unanimous. They're all buying. The National Bank of Poland just announced they're increasing their gold reserves to 20% of total reserves. 20%. The Reserve Bank of India bought 9 tons in October alone. Turkey, Uzbekistan, Kazakhstan, they're all loading up. These aren't amateur investors making emotional decisions. These are the most sophisticated financial institutions on the planet, with access to data and analysis that you and I will never see. And they're telling us, through their actions, that gold is about to become significantly more valuable. But here's where it gets really interesting. While central banks are buying physical gold, something bizarre is happening in the paper gold market. The COMEX, which is the primary exchange for gold futures in the United States, is showing signs of extreme stress. The ratio of paper gold to physical gold has reached levels that are frankly unsustainable. We're talking about claims on physical gold that exceed actual deliverable supply by factors that would make your head spin. I want you to imagine a scenario. Let's say you go to your bank and you want to withdraw your money. But when you get there, the bank tells you, sorry, we don't actually have your money. We have a piece of paper that says you're entitled to money, but the actual cash, that's been lent out to 100 other people. You'd be furious, right? You'd demand your money immediately. Well, that's essentially what's happening in the gold market, except most investors don't even realize it. The paper gold market has created this illusion of abundant supply. Traders buy and sell gold futures contracts, moving billions of dollars around, but very few of those contracts ever result in actual physical delivery. It's a shell game, and it's been suppressing the true price of gold for years. But that game is coming to an end, and when it does, the price adjustment is going to be violent. Let me tell you a story that perfectly illustrates what I'm talking about. In 1971, President Nixon closed the gold window. Up until that point, foreign governments could exchange their US dollars for physical gold at a fixed rate of $35 per ounce. But the United States had been printing so many dollars to fund the Vietnam War and domestic spending programs that foreign governments started to get nervous. France, under Charles de Gaulle, actually sent a warship to New York to collect their gold. They didn't trust paper promises anymore. They wanted the real thing. Nixon had a choice. He could either continue honoring the gold standard and watch America's gold reserves disappear, or he could break the promise and close the window. He chose the latter. And what happened to gold prices after that? They went from $35 an ounce to over $800 by 1980. That's a 2,200% increase in less than a decade. Now, I'm not saying we're going to see a 2,200% increase from current levels, but I am saying we're at a similar inflection point. The difference is, this time it's not just the United States that's in trouble. It's the entire Western financial system. Look at what's happening with the BRICS nations Brazil, Russia, India, China, South Africa. They're actively working to create an alternative to the US dollar for international trade. They're tired of being subject to American monetary policy. They're tired of sanctions. They're tired of watching their dollar reserves lose value through inflation. And their solution? a gold-backed trade settlement system. Now, the mainstream media will tell you this is impossible. They'll say the dollar is too entrenched, that there's no alternative, that this is just posturing. But I'm watching what these countries are actually doing, not what they're saying. China and Russia are settling bilateral trade in their own currencies. Saudi Arabia is accepting yuan for oil sales. The United Arab Emirates is stockpiling gold. These aren't theoretical discussions anymore. This is happening right now. And here's the thing that should terrify anyone holding significant dollar-denominated assets. When the dollar loses its reserve currency status, even partially, the amount of dollars that will flow back into the United States is going to create an inflationary tsunami. We're talking about trillions of dollars that are currently held overseas, used for international trade, sitting in foreign central bank reserves. When those dollars come home, when they're no longer needed for global commerce, they're going to chase a limited supply of goods and services in the U.S. economy. What happens to prices when you have too much money chasing too few goods? They go up, way up. And what's the traditional hedge against inflation? Gold. But let's talk about something even more immediate. The U.S. national debt just crossed $36 trillion. $36 trillion. The interest payments on that debt are now over $1 trillion per year. That's more than we spend on defense, more than we spend on Medicare. We're paying $1 trillion a year just to service the debt, and that number is growing exponentially. How do you think the government is going to handle this? They have three options. They can cut spending dramatically, which is political suicide. They can raise taxes significantly, which is also political suicide. Or they can print more money and inflate away the debt. Which option do you think they're going to choose? The Federal Reserve has already shown us their playbook. During the 2008 financial crisis, they printed trillions of dollars through quantitative easing. During the COVID pandemic, they printed even more. And every time they do this, every time they expand the money supply, gold goes up. It's not a coincidence. It's cause and effect. Now, I know some of you are thinking, but the Fed has been raising interest rates. They're fighting inflation. Doesn't that hurt gold? And on the surface, yes, higher interest rates make gold less attractive because gold doesn't pay interest or dividends. But here's what you need to understand. Real interest rates, that's the nominal interest rate minus inflation. Those are still negative in many cases. And even when they're slightly positive, they're nowhere near high enough to compensate for the actual loss of purchasing power. Let me give you a concrete example. Let's say you put your money in a savings account earning 5% interest. Sounds pretty good, right? But if real inflation, not the manipulated CPI number, but actual inflation in the things you buy every day, if that's running at 7 or 8%, you're losing purchasing power. You're getting poorer in real terms, even though your account balance is going up. Gold doesn't have that problem. Gold maintains its purchasing power over time. An ounce of gold today buys roughly the same amount of goods and services that an ounce of gold bought 100 years ago. Can you say the same thing about the dollar? A dollar in 1924 had the purchasing power of about $17 today. The dollar has lost 94% of its value over the last century. Gold hasn't. And here's something that's absolutely critical to understand. We're not just dealing with inflation anymore. We're dealing with the very real possibility of a currency crisis. When you look at the fundamentals of the U.S. economy, the debt levels, the unfunded liabilities, the political dysfunction, the social unrest, you have to ask yourself, how long can this continue? I want to share something with you that I think is really important, especially if you're someone who's worked hard your whole life, saved diligently, and you're now in or approaching retirement. You've probably got a significant portion of your wealth in traditional retirement accounts, 401s, IRAs, maybe some brokerage accounts. And most of that is probably in stocks and bonds because that's what everyone tells you to do, right? Diversify across stocks and bonds and you'll be fine. But what happens when both stocks and bonds are overvalued? What happens when the currency those assets are denominated in is losing value? You're not actually diversified. You're concentrated in dollar-denominated paper assets, all subject to the same systemic risks. Now, I put together a free guide that explains how gold IRAs work. It's in the description below. It covers how you can get physical gold into your retirement account without triggering tax penalties or early withdrawal fees. If you've got $100,000 or more in retirement savings, it's worth taking a look at. I'm not saying you should put everything into gold, but having some exposure, having a portion of your wealth in an asset that's not dependent on government promises or corporate performance, that's just smart risk management. All right, back to what's happening in the market right now, because this is where things get really fascinating. The gold mining sector is showing us something remarkable. The cost of producing an ounce of gold has been rising steadily. We're talking about all-in sustaining costs that are now averaging around $1,300 to $1,400 per ounce for many producers. That means at current prices around $2,600, miners are making healthy profits. But here's the thing, they're not increasing production. Why not? Because they can't find enough high-grade deposits. The easy gold has been mined. The remaining deposits are deeper, lower grade, in more difficult locations. It takes years to bring a new mine online, and the capital requirements are enormous. So even though gold prices have been rising, supply is constrained. Meanwhile, demand is exploding. It's not just central banks. We're seeing record demand from retail investors in Asia. In China, gold vending machines are popping up in shopping malls. In India, despite government efforts to discourage gold buying, demand remains insatiable. These are cultures that have understood the value of gold for thousands of years. They don't trust paper currency. They don't trust government promises. They trust gold. And now, Western investors are starting to wake up. Gold ETF holdings, which had been declining for a couple of years, are starting to turn around. Smart money is rotating out of overvalued tech stocks and into hard assets. They're looking at the risk-reward profile and realizing that gold, even at current prices, offers better protection and upside potential than most other assets. Let me paint you a picture of what I think is about to happen. We're in the early stages of a gold bull market that could last for years. Not months, years. And the catalysts are lining up perfectly. You've got central bank buying that shows no signs of slowing down. You've got geopolitical tensions that are escalating, not de-escalating. You've got currency debasement happening in every major economy. You've got supply constraints in the mining sector. And you've got a growing recognition among investors that the traditional 60-40 stock-bond portfolio is not going to protect them in this environment. When all of these factors converge, when the paper gold market finally breaks under the weight of its own contradictions, when physical demand overwhelms available supply, we're going to see a price spike that makes previous rallies look tame. I want you to think about what happened in 2011. Gold hit $1,900 an ounce, and everyone said it was a bubble. They said it couldn't go higher. And you know what? They were right for a while. Gold corrected, went into a bear market that lasted several years. But here's the difference between then and now. In 2011, central banks were still pretending they could normalize monetary policy. They were talking about raising rates, reducing balance sheets, getting back to normal. There was still faith in the system. That faith is gone now. Everyone knows the debt is unsustainable. Everyone knows the money printing is never going to stop. Everyone knows the dollar's days as the sole reserve currency are numbered. The question isn't if gold is going higher. The question is how high and how fast. Some analysts are calling for $3,000 by the end of next year. Others are saying $5,000 within 5 years. The more aggressive forecasts are talking about $10,000 or higher if we see a real currency crisis. And you know what? None of those numbers sound crazy to me anymore. When you look at the amount of currency that's been created, when you look at the debt levels, when you look at the geopolitical realignment that's happening, gold at $10,000 an ounce might actually be conservative. But here's what I want you to understand. This isn't about getting rich quick. This isn't about speculation or gambling. This is about preserving wealth. This is about making sure that the money you've worked your entire life to accumulate doesn't evaporate in a currency crisis or get inflated away by reckless monetary policy. Think about the people who held gold through the 1970s. They watched their purchasing power not just survive but thrive, while everyone else saw their savings destroyed by inflation. Think about the people who bought gold in the early 2000s when it was under $300 an ounce. They rode it all the way to 1900. That's a 600% return, and more importantly, they protected themselves from the 2008 financial crisis. We're at a similar moment right now. The signs are all there. The smart money is positioning. The central banks are accumulating. The fundamentals are screaming that gold is undervalued relative to the amount of currency in circulation. And here's something that should really get your attention. The gold-to-money supply ratio is at historic lows. If you take the total amount of gold in the world and divide it by the total money supply, you get a ratio that tells you how much gold backs each unit of currency. That ratio is lower now than it's been in decades, which means either the money supply needs to contract dramatically, which isn't going to happen, or gold prices need to rise dramatically to restore balance. I've been studying markets for a long time, and I've learned to pay attention to what the big players are doing, not what they're saying. And right now, the big players are buying gold, quietly, consistently, aggressively. They're not waiting for confirmation. They're not waiting for the mainstream media to give them permission. They're acting on the information they have, and they're positioning themselves for what's coming. You have the same information now. You can see the same trends. You can read the same data. The question is, what are you going to do about it? Are you going to wait until gold is at $3,000, $4,000, $5,000 and wish you had acted? Or are you going to position yourself now while there's still time? Because here's the thing about major market moves. By the time everyone agrees it's happening, by the time it's on the front page of every newspaper and the lead story on every financial news channel, it's too late. The easy money has been made. The smart money has already positioned. You're buying at the top, not the bottom. Right now, we're in that sweet spot where the trend is clear to anyone paying attention, but the crowd hasn't caught on yet. The mainstream narrative is still that gold is a barbarous relic, that it doesn't make sense in a modern economy, that you should just buy index funds and forget about it. But that narrative is crumbling. Reality is asserting itself. And the reality is that gold has been money for 5,000 years, and it's going to continue being money long after the current crop of fiat currencies has been relegated to the history books. I want to leave you with this thought. Every major empire in history has eventually debased its currency. Rome did it, Spain did it, Britain did it. And every time, the people who held gold were the ones who preserved their wealth through the transition. The people who trusted in the government's paper promises were the ones who lost everything. We're living through one of those transitions right now. The American empire, the dollar-based financial system, it's not going to last forever. Nothing does. And when the transition happens, when the reset comes, you want to be holding real assets, not paper promises. Gold is that real asset. It's no one's liability. It can't be printed. It can't be debased. It can't be hacked or frozen or confiscated easily. It's been valuable for all of human history, and it will continue to be valuable long after we're gone. The upswing is coming. The evidence is overwhelming. The question is, are you going to be ready?